Welcome. You're listening to The Best of Investing. I'm your host, Edward Brown. My two co-hosts, Mark Humph and Nam Phan, are off today, but I've got a special guest coming up in about 30 seconds here. Our phone number is 888-912-1190. Use that number to answer the trivia questions for a 5-pack tanning certificate given away during the show. And those certificates are not sponsored by the radio station, but by Tan Bella Tanning Salon with 2 locations in San Francisco and 1 in Marin. And since the weather's going to be heating up here pretty soon, you got to get your tan on. Check them out, tanbella.com. And today's trivia theme is entertainment. Today's special guest, we've had him on before. You know him, Dane Moeller. Dane Moeller. Why do I have Dan here? I'm going to put an E in your name there. Dane Moeller, a primary residential mortgage. Dane, welcome back.
Thank you very much. Good to be here. And not the first or last time I'll be called Dan, I can tell you.
No, you know what? I know your name is Dane. For some reason, I was typing so fast, and I left the E off. And it didn't auto-correct me because Dan is a name. Okay, so now last time, I think you were making some predictions, and unfortunately, they came true, didn't they?
That is the case. You know, when I was on last time, I think interest rates were in the mid to higher 3s and moving up. And I was saying, hey, grab the 3s where you got them because they're going to be gone soon. And as of today, I think I can officially kiss them goodbye. Unless you're paying some significant cost or doing a 10 or 15-year fixed. But for your standard 30-year fixed, for any normal homeowner not paying a lot of points, you're now firmly in the 4%.
Oh, is it right at 4?
No, it's above 4.
Ooh.
And I was looking at a scenario today. And it's, it was 4.375 for a pretty well qualified person.
Wow, so that's almost 4.5.
Yeah, I mean we're getting there, and for investment properties and things like that that have some or lower credit scores, the 5s are really in the conversation again.
Wow, and correct me if I'm wrong, but the Fed's already kind of announced that this is probably one of the next 6 hikes that are coming. So one would think that you still have to kind of grab it now. Don't wait for it to drop anytime.
Interest rates are going to continue to increase, although I hope we can find some sort of footing. It's been a really rapid increase. It was only 90 to 100 days ago we were talking about the 2s, right? So we've had a rapid increase, and there is anytime any sort of financial market moves in one direction to that degree for that amount of time, there is resistance and likelihood of some stability. So hopefully we'll stick here and go back down. But I think long run, things are going to go up. Mortgage rates in general like the Fed to increase, which may sound very counterintuitive. But what mortgage rates dislike, if you're going to give them a personality, is inflation, right? That is what is the killer of low interest rates, is inflation. And that's why they're going up so much. That's the number one reason. It's really kind of the only reason, everything that's leading to inflation. When the Fed raises rates, they're actually combating inflation.
Yeah.
So if the Fed had raised rates 50 basis points this week rather than 25, I would argue mortgage rates would have come down pretty significantly, because mortgage-backed security investors would say, hey, the Fed's getting pretty serious about fighting inflation, and maybe we can not expect as much. Maybe we don't need to charge so high a rate, right? But at 25 basis points, they're going, yeah, that's not going to do anything when inflation's running 7%, 7.5%. What's a 5% BIP increase going to do?
But it's been announced that they're going to probably be raising another, probably in increments of 25 basis points, one would think, if they're going to do it 6 more times.
Yeah, they've said 6 or 7 more times over the next 5 or 6 meetings. So that would say at least one 50 base increase somewhere. Some Fed officials have even talked about increases in between meetings, which has never happened. So they do have a plan. They're walking the tightrope. I mean, on one side, they raise too quickly, they're going to rocket us into a recession. On the other side, they don't raise enough. Inflation's going to do that on its own, and we're all going to be paying a lot higher prices for what we
but it sure seems like they could at least help one major part of inflation if they were to turn on the spigots a little bit more on oil, and at least that part of the equation, and it's funny because I think about this, that even if you're, well, if this is getting a little bit on the political side, but if I understand it correctly, they're saying no drilling in America. Okay, yay, we're going to save the planet. However, we're going to import it from Venezuela, Iran, and other countries where their oil is less clean, and it's still going to be, you're still going to have high prices. So you get the worst of all worlds. I mean, why couldn't they open up the pipeline or whatever you want to call it, the keystones, et cetera, and just keep and drop the prices down? And then if they want to go back and say, okay, now stop, we're going to, go back to what we were doing before. Am I wrong?
Well, I mean, you're certainly treading into the political side.
Yeah,
of things.
yeah.
I mean, we do have a strategic oil reserve, which is they're tapping into very small.
Yeah, but that's only 30 million barrels apparently, which is like a blip, isn't it?
Yeah, it's kind of a blip, but I mean, they can do that, and they can do the other things you're talking about in terms of bolstering, domestic production. Some of those are longer term though. They're not going to. You can't just turn on the tap tomorrow, right? New drills, they don't get you oil the next day, right?
No, not.
And,
not
the Venezuela Iran stuff is an interesting thing that they're trying to do, but overall we're going to need less demand or more supply, right? And with what's going on in Russia, and Ukraine, it's hard to see that on the horizon. It is interesting how at the gas pump, they raise prices as soon as they know what their replacement gas is going to cost, right? Yeah. The gas they have there now didn't cost what it's going to cost.
No. But I mean, how quickly do they go through that, though?
Well, I mean, I don't know. You see those trucks there, but how long does it take from the oil to
a couple of days, maybe?
Right? But then when prices go down, they're like, well, that's what we spent for that gas, so we can't lower it yet. So we as consumers get it on both ends, I think.
But I mean, it's all supply and demand, it seems like. But unfortunately, it hurts the people who can't afford it the most.
Yeah.
Because everybody drives. Okay, here we go. Here's our first trivia question. We're talking entertainment. And again, as a reminder, Dane, if you know the answer, don't say anything until we get back from break. First trivia question in the entertainment field. According to Elton John, what were we hopping and bopping to? If you remember his song back in the 70s, call 888-912-1190. The first caller with the correct answer is going to win that tanning certificate. Again, according to Elton John, what were we hopping and bopping to? All right, you're listening to The Best of Investing. Stay with us. Don't touch that dial. We're going to be right back. Welcome back to The Best of Investing. Again, I'm Edward Brown, your host, along with my special guest, Dane Moeller of Primary Residential Mortgage. All right, our first trivia question. According to Elton John, what were we hopping and bopping to? You remember that song?
I do. Great movie. And I remember in the movie, it was Crocodile Rock.
Crocodile Rock, yeah. Was that in Tommy? What was the movie? I mean, I was just saying, what was the movie?
The Elton John movie. I forget.
Okay. That just came out. Okay, I was thinking of the movie Tommy. That was actually Pinball Wizard. Which is kind of funny because Pinball Wizard, The Who played the instrumental part of it better, but Elton John has a better voice. So they should have kind of put the two bands together to do that song.
Right.
All right. I want to make a quick mention here for the Mount View Hotel and Spa in Calistoga. So every afternoon they have vino and vinyl wine tasting. And on Fridays and Saturdays, once the weather gets better, join them for dinner and a movie on site. So when you're ready for a change of scenery, make yourself at home at the Mount View Hotel and Spa in Calistoga, which, by the way, I've been there. One of the nicest pools. It's a phenomenal place. So making memories for 100 years, that's the mountviewhotel.com. So again, our special guest is Dane Moeller, Primary Residential Mortgage. He's quite the expert in mortgages. And unfortunately, his prediction did come true about rates going up. And I told him I was going to give him one of those Karnak hats that the Swami that Johnny Carson used to wear. So if you could give us a lowdown on interest rates as of today, 15-year, 30-year, conforming, jumbo, what are we saying?
Yeah, so if we're talking about no points here, and anyone who's ever finding out about interest rates, very important you find out about the cost of the loan as well. Anyone can quote you a rate, but if they don't tell you the cost, they're not giving you the whole picture. So if we're talking no points, conforming 30-year fixed are now in the low fours, just above 4%. 15-year fixed are holding on to the high threes. Okay. Conventional high balance, which we have in the Bay Area and high cost areas, are mid fours to higher fours because there's a recently passed tax on high balance loans. But jumbo loans, if you can qualify for the stricter guidelines, are much lower. So jumbo loans, 30-year fixed, still in the very high threes, low fours range, and 15-year fixed, a little bit lower than that. So we've gone, this has happened in the past at other times, but currently jumbo loans are less expensive than a conforming loan, which isn't what you normally think or what normally happens, but it does happen at times. And the government has passed so many taxes on loans that are purchased by Fannie Mae and Freddie Mac. They call them loan level price adjustments, but they're really taxes. And they've passed more of them recently, really significantly on second homes. Second homes now, rates are much, much higher as a result of these taxes.
Besides the typical, government wants to just steal as much money as they can attitude, what is there anything specific behind those extra taxes?
Yeah, so this one around was less about stealing money for other things. A lot of times these taxes have been used to pay for roads and things that don't have to do with housing. Yeah. The Federal Housing Finance Authority, FHFA, who runs Fannie Mae and Freddie Mac, their goal is to promote home ownership in America. And one of the things they've seen is the rise in second homes during the pandemic. And that's kind of crowding out primary home buyers. They've also seen people borrowing more money to have high cost areas, which is pushing up pricing theoretically, right, in higher cost areas. So they passed a new tax on second homes that make the loans much more expensive. And the idea there is that will help a primary home buyer compete in those markets, right? So it's not fun if you're the second home buyer, but if you live in Truckee, you want to buy a house, this is a welcome tax because now your competitors from the Bay Area.
Unless the competitors have all cash, and then which a lot of them.
They all cash, then it doesn't matter, right? And Fannie Mae and Freddie Mac can't do anything about that. So they, this is what they can.
You know what? Of course they can. They can just say, if you're paying all cash, we're going to tax an extra such and such. I mean, it's crazy. I heard that there's a lot going on. They're trying to pass a law.
The federal government and the state can do that, but not Fannie and Freddie because they're only on the loans.
Well, they can't. But apparently, California wants to pass some law that if you have a house that you sell within, I think it's 3 years, they want to do an extra capital gains tax on it. Do you hear about that? Hasn't passed yet, and the real estate industry is trying to, fight it. But
yeah, I have heard some rumblings on that, and it's interesting. It's interesting because there is a really important part of the housing market, which is the fix and flip investor. There are a lot of houses out there that we can't loan on that you probably can, but the traditional mortgage lender it doesn't meet health and safety standards. It's not sure. There's plumbing that isn't working, or there's missing important aspects, and there's investors that go in and they buy these homes, they fix them up, and then they sell them for a profit. And it's an important aspect of refreshing the housing stock. For people that they don't want a project, they want a house they can live in. And so if they had extra capital gains, ultimately that would just mean higher prices for the next buyer, so those people can stay profitable.
Yeah.
So it's maybe sounds good in practice, but it's just going to be inflationary and cost us all more money.
It just I don't know. I think the government kind of sits down around a table and says, okay, how can we steal money from the public without it kind of like really calling it stealing? So they just come up with all this stuff. And one of my predictions on Roth Iras, if you're familiar with Roth Iras, in theory, you're supposed to pay tax on the money going in, but then it builds up tax-free. And then when you take it out, it's going to be tax-free. So my prediction is that they won't just come out and say, hey, guys, we changed our mind, taxpayers, suddenly, thumb in the nose, thumb in your nose like that and going, we're going to tax you on it. Well, that'll be a little bit too obvious. But what I think they'll do is they'll say, if you've got money in a Roth IRA, you have to at least report it on your tax return, even though you don't pay taxes on it. However, it'll push you up into a higher tax bracket for other reasons, or they'll say, oh, well, now you have other investment income. So since you have this income, we're going to tax you more on that income. So effectively, it's still another tax that they're going to be able to do. And they kind of do it right now with alternative minimum tax on municipal bonds, where there's certain kind of, they call them AMT bonds. So in theory, you're not supposed to pay taxes on your municipal bond interest, but certain ones have this alternative minimum tax. So they're always kind of figuring a sly way of getting more money from the public. All right, here we're going to cut to our second trivia question. Who played Laurie Strode in the 1978 horror film Halloween? Now, I never saw the movie, but I know she was in this movie because she's a famous actress. Who played Laurie Strode in the 1978 horror film Halloween? All right, call 888-912-1190. First caller with the correct answer wins that tanning certificate. Stay with us. Best of Investing. We'll be right back. Welcome back to the Best of Investing. Edward Brown here, along with Dane Moeller of Primary Residential Mortgage. Our second trivia question: who played Laurie Strode in the 1978 horror film Halloween?
I got no guesses on this.
No good. Jamie Lee Curtis.
Oh,
yeah. So I think that was probably one of her breakout roles, because then she ended up doing Trading Places. Remember that? And then Freaky Friday, and then some other stuff. Yeah, I didn't see the movie, but if someone said what famous actress is in the movie Halloween, I go, oh yeah, Jamie Lee Curtis. Okay. The next question will be a little easier. Don't worry. All right. So Dane, you've got your finger on the pulse from the housing market as well, since you're in the mortgage. Which, by the way, before we forget, since you're such a whiz at the mortgage market, how do people get a hold of you if they're interested in checking out mortgage rates with you?
Yeah, absolutely. You can give me a call. My name again is Dane Moeller at Primary Residential Mortgage. Phone number is 415-870-2752. I'm right here in the Bay Area. And email is D as in David, M as in Mary, OLER at primeres.com, PRIMERES.com.
PrimeRes, I like that. All right. So tell us what you see is going on in the housing marketplace.
Well, we've had a very depressed supply, which is no surprise to anybody, and it's been extremely tight January and February to start this year. I think that I read the other day that there was less than 2 weeks of inventory based on how many buyers are out there, meaning that if the inventory is there, it could be purchased in 2 weeks, and if no new houses come on the market, there would be nothing left.
Wow.
A healthy market runs at about 2 to 3 months of supply. So if we're talking 2 weeks, it's very low. Rental prices have gone up quite a bit. The newest numbers just came out yesterday. Year over year in January, this is nationwide, 12.4% increase in rent.
Wow. Now, how much of that has to do with coming out of the pandemic, do you think?
Well, I mean, it's all demand and supply. It's interesting because I don't think any landlord's costs have increased by 12% during that time period. So it's not.
But that's a good question. Maybe if they had work done, where they had plumbing and other things they needed to hire a contractor potentially.
Well, I mean, there's always cost to home ownership for sure, but
yeah.
To give some context, the previous January to January increase was 3%.
Oh,
we're at a 4x multiple of the rent increase from 20 to 21 versus 21 to 22 if you're looking at January's. So the competition for housing, both in renting and buying, is extremely fierce right now. And I think that a lot of it has to do with pandemic changes of the importance of having your own space, having your own home, people going into different markets because they can work from home and needing more space to do that.
Do you see that changing?
Well, I was talking with some agents this week, and they talk to staging companies that go in and get a home ready to sell, and that's how they can get a little idea on what's coming up in the market other than talking to other agents. And apparently the staging companies are very busy. So we may see, we're entering the spring market, which is the biggest market for most of the Bay Area counties. We may see some stuff hit the market. My hope is that there's a good number of people out there whose houses now are worth more than they ever thought and are ready to, cash in and potentially move to another area. Because if they're cashing in and staying in the area, that's another buyer. That doesn't help anything, right? That's a one-to-one situation.
Yeah.
So we need, not that I want anyone to move, but for the housing market, supply and demand, we would need sellers that are not buyers, right? Sellers that either own an investment property or sellers that are moving out of the area, because that's how you can get more supply. If it's sellers buying in the same area, that's a one-to-one exchange and doesn't change.
I see what you mean. Yeah. But now, what is your territory? Do you lend just the Bay Area, just California?
So I live in California and Oregon. The company I work for is nationwide, other than New York City, or New York State, excuse me. But I'm licensed in California and Oregon. Majority of the work I do here is in the Bay Area, but I do a lot of stuff in LA, where I'm from originally, and San Diego, and then the Central Valley, and then also in Oregon.
Why Oregon? What were you just a lot of people moving from California to Oregon, or how'd you get it?
Yeah, my sister lives there, so I have some family connections, and the lending guidelines are very similar in Oregon and California. Some states are a lot different, but California and Oregon are very complementary, and we do get a lot of people that are moving north. I'm actually considering my Washington license, because now that trend is continuing even further. And now we're getting a lot of people that are going in one more state to try to find, that nice mix of nice house, big lot, smaller price.
Yeah, because the prices in Washington and Oregon, are they somewhat, well, I know it depends on the area, but.
It depends on the area. I mean, if you were to look at Seattle versus Portland, I think Seattle is more expensive.
Yeah.
But I think that, on the eastern side of both the states or in the central parts, it's very market specific.
Yeah, because I know like Lake Oswego, that's a pretty nice area, isn't it?
Yeah, very nice. Yeah, I've done a good number of loans there.
Okay. And then like specifically for your market, it's kind of interesting because it's like, I think, okay, well, almost any movement in interest rates is good for you because it just makes it the activity.
Yes, although movement down is way better than movement up.
Yeah, because people refinance.
When rates start moving up, people get off the fence and get things going. But as rates go up, there's less benefit to refinancing, or you might consider an equity line for your cash out versus a new first mortgage. And on the purchase side, there are people that then, as rates go up, their purchase price potential goes down. So, unfortunately, you're calling somebody and saying, hey, you were here at a maximum, now that maximum is lower. And at the same time, house prices have gone up. So now it's a double whammy of you can afford less, your house payment didn't get any cheaper, and houses have gotten more expensive.
And that's the thing is
that's a little depressing news to deliver to people.
Well, what one wonders that if rates go up, I mean, at some point, if rates go up too much, it really will affect the prices of houses for that reason, where, telling someone they have to pay an extra $115.06 a month because of their interest rate going up is not going to probably change their life. But if it goes up $800 a month more, that can be a huge change. And so the prices of the houses, may get a lot more limited.
Absolutely. I mean, there's a large amount of cash buyers that it doesn't affect. But a majority of people are still buying with a loan. Gotcha. And if you're delivering that increase or a lower purchase price, it can make a difference.
All right, we're going to cut to our next break. Next time, we'll ask our trivia questions. Stay with us. Best of Investing. We'll be right back. Welcome back to the Best of Investing. I'm Edward Brown, along with Dane Moeller. And we didn't ask our trivia question. We're going to ask it next time for the last break. But Dane, you want to talk about housing mortgage payments, right?
Well, yeah, we were talking about payments a little bit, but what I wanted to talk about a little bit, I've been a little doom and gloom about mortgage rates and the mortgage market and the housing market on this call, but not all is bad. Lending guidelines are loosening up, jumbo specifically, and also down payment and closing cost assistance programs are going strong, and we have a new one coming out that will offer a 95% loan with 5% for down payment and 5% for closing costs as a 10% second that is completely forgiven after you've owned the home for 5 years.
Really? Wow.
10% of, in essence, gifted money to cover your down payment and cover your closing costs with a 95% loan. And that's all forgiven. So that's an amazing way to get into a house for almost no money, or even practicality for no money. So
now, is that FHA product?
We can layer it with a FHA or a conventional first product.
But I mean, who forgives the loan?
The California Housing Finance Authority. So
it's got to be California.
Agency. Yeah, that's a state agency that provides the funds. And there's an income minimum and an income maximum. So it's for a specific segment of the home buyers. But those out there facing those increased rents we talked about, if you have a good job and you have decent credit and you want to get to something where you can have a fixed house payment, don't be daunted if you don't have the down payment. That's something to give me a call and talk about, and see if we can get you into a house without anything down or with very little.
And do you have to? You probably still have to have PMI though with that, don't you?
You would still have mortgage insurance,
Okay.
but mortgage insurance, like property taxes, is just another expense of home ownership, and just something to factor in.
What percent is it? It's not 1%, is it? Generally.
So for the FHA, they have a defined table based on some factors. It's usually 0.85% for most people. It could be 0.8, 0.85. It can be a little more if you have a higher loan amount. Private mortgage insurance is offered by private companies, and they take into account lots of different factors to come up with a rate. But it can be as low as 0.1%.
Really?
So
Okay, that's great.
Sometimes for people with good credit, and maybe doing 15% down, it might be $40 a month. And people are like, oh my God, that's all it is. I heard that private mortgage insurance is this big, terrible thing. And it's like, $40 a month, and it'll fall off right on a conventional loan.
Yeah, once you get over 20% equity, right?
20% equity, or you pay your balance down by 22%. So if your house doesn't go up at all, it goes down, your MI could still fall off as you pay down your mortgage.
Yeah, because every mortgage payment you pay is some principal and interest. There's the principal to get that down. Wow. And it used to be guidelines were like you couldn't. Was it 43% of your income couldn't go to mortgage? Is it still that number, or they loosened that?
It's much more liberal than that. That is a guideline. Jumbo generally will stop at 43, but now we have products that go to 45 or even 50 for jumbo, and FHA 55, VA, I've seen 60, 65, even 70% for the right buyer. So there are solutions out there, and I will say it's a little scary to think about, but as the banks slow down, they're going to open up the credit box a little bit. And we did see that in 2006 and 7, because we had a big rush in 2003 and 4 for refis.
Yep.
All these banks wanted to stay in business, so they started loosening guidelines to get more customers, and we had 6 and 7 happen. Now, there's a lot of federal laws that have been passed to stop negative amortized loans and loans with gigantic prepayment penalties, and all the really bad things can't happen again.
Yeah.
But we will see some more flexibility.
We also have the ability to repay rules too.
Those are the ones I'm referring to. I mean, those have all been passed, and that will help prevent the same sort of housing catastrophe that we have.
Which is smart. I mean, that's one of the few times when I say, you know what, government regulations, maybe they swung the pendulum a little bit too much, but at least they got something in place to kind of help.
Absolutely, I agree.
Because I mean that's a whole catastrophe economic for everybody wise. And so again, give out your information. How do people get a hold of you? Because especially that forgiven portion of the loan, that's a good one.
Yeah. So people, again, Dane Moeller is my name. You can give me a call at 415-870-2752, or you can email me at dmoler@primeres. That's PRIMERES as in Sam.com.
Very good. So a little update here at Pacific Private Money. We're going to do somewhere between 800 million and $1 billion. I mean, it's just crazy. We're just adding so many brokers pretty much around the country now. And since we don't really do, we don't really compete with you because we're not doing those kinds of loans. We're doing the ones that are a little bit more either challenging, or they need more speed, or there's some reason why they can't get a conventional loan. They come to us at Pacific Private Money. And for the investors, we have a few different a few different funds. One of them is called our Freedom Fund, where first of all the funds, you have to be an accredited investor. So you have to have a net worth exclusive of your home of $1 million, or if you're single, 200,000 a year income, 300,000 if you're married. And if you qualify, You can go into any one of our funds. One of them is the Freedom Fund, which is paying just a flat 6%. No higher, no lower. But the cool thing about it is that it's almost like a money market account in that there's no fee to get in, no fee to get out. You just have to give us 30 days notice when you want your money. So even though the documents say it's a 1-year hold, there's no early withdrawal penalty if you take your money out early. So effectively, all we're talking about is you put your money in, and as soon as you want your money back, just give us 30 days notice. And sometimes we can actually pay it back even sooner, because what we're doing with the money is doing a bunch of loans, packaging them up, selling them, and then the money comes back, and then we put it on the conveyor belt and do more loans. So from a timing standpoint, we've had people put in their request they needed their $1 million back, and we just happened to have been paid off 2 days earlier on loans. So they didn't have to wait 30 days. They only had to wait 2 days to get their money out. So it's a very good way to use short-term investment money while you're waiting for something else. People put it in there for months, 2 months, 6 months, and until they buy their next piece of property or invest in the stock market or whatever they want to do. So it's a good holding tank. Are you ready for our third trivia question? We forgot to ask it last time. We were running out of time, but so we're going to ask it this time. What was Smokey Robinson's backing band? If you know what I mean, what was the band that backed Smokey Robinson? All right. So I'll give you a hint. It's Smokey Robinson and X. All right. That's our trivia question. Call 888-912-1190. First caller with the correct answer is going to win that tanning certificate, which is worth over $100. It's a nice little gift there. One more time. What was Smokey Robinson's backing band? And when we come back, we're going to answer that trivia question, talk about a few more of the funds and what the rate of return we're paying on that. And then we'll have our thoughts today. All right, stay with us. You're listening to The Best of Investing. Don't touch that dial. We're going to be right back. Welcome back to The Best of Investing. Again, I'm Edward Brown, your host. We had to say goodbye to Dane Moeller, but really enjoyed him joining us, learning all about what's going on with rising interest rates in the market. So our third trivia question was, what was Smokey Robinson's backing band? In other words, it was Smokey Robinson and the answer was The Miracles. So we're going to spend a few minutes here just kind of going through a few items on the Pacific Private Money family of funds, because it's very interesting how they have 4 different funds with different objectives. Their most conservative fund is one called the Freedom Fund, has a minimum investment of $250,000, and it pays a flat 6% interest, 0.5% per month. And you can either take the monthly distributions or you can have them reinvested. All of the funds that Pacific Private Money provides, you do have to be an accredited investor. And the definition of that is a net worth exclusive of your home of at least $1 million, or if you're single, you make $200,000 a year, and if you're married, you make $300,000 a year. There's no fees to get in, there's no fees to get out. The nice thing specifically about the Freedom Fund is the fact that although there's a 12-month lockup, there's no early withdrawal penalty for getting out early. You just have to give 30 days notice. So imagine it very similar to a money market account where you put your money in, and then whenever you want your money out, you just give 30 days notice. There's no check writing ability, but it's possible that you can get cashed out in less than 30 days if the money comes back from Wall Street. Because what are they doing with the money? They are originating notes, mortgages backed by real estate, and then they sell them to Wall Street. And then every roughly 2 to 3 weeks, they get a big check back from Wall Street, put it on the conveyor belt, and send it on out again. And so it's just a constant flow of money that goes in and out. And that's how they can provide liquidity to their investors. Their legacy fund is the Pacific Private Money Fund. It does loans where they are portfolio lending, so they're holding them. Loans are kind of similar to the ones that are in the Freedom Fund for the most part. And that is only a $50,000 minimum. They are paying a 6% distribution, preferred return plus half the profits. Right now, that adds probably another roughly 15 basis points, 25, could be higher than that. That one does have a 1-year hold on it. And then after that, you just give 30 days notice. They also have the Pacific Southwest Note Fund, which is buying primarily discounted seller carryback notes in Texas. The yield on that is just a flat 7.5%, similar to the Freedom Fund, that there is basically no hold. You just give 30 days notice. That one only has a $50,000 minimum. Their last fund is the North Star North Star Capital Fund, which is a construction loan fund. That one has actually been yielding a lot higher than projections. They pay a preferred return of 8% plus half the profits, which usually adds another 2%. But actually, they've been paying a little bit closer to 12%. But we just tell people just count on 8% plus some profits, and you should be fine. That one pays quarterly. It has a $100,000 minimum, and it does have a 1-year hold. So those are the 4 funds. And for more information, you can call 415-883-2150 or go to pacificprivatemoney.com. The email is investor.relations@pacificprivatemoney.com. So we're going to cut out for today, and here's our thoughts for the day. What's the difference between unlawful and illegal? Unlawful means against the law, while the other is a sick bird. Illegal. Get it? Yes. Okay. And my wife told me that one of these days I'll die of stubbornness, and I could only reply, no, I won't. Where's the canned laughter for that? Audience, go on. You got to get that. All right. Tune in next week to The Best of Investing. We'll be giving away more free prizes for answering trivia questions. Thanks for listening. On behalf of our team, I'm Edward Brown, wishing you the best of investing. So long.